The Rothschild banking dynasty established an international framework in the late 18th and early 19th centuries that facilitated capital movement across borders and supported government financing during major European conflicts. The structure relied on coordinated branches in key cities, enabling rapid response to economic opportunities and crises. In the American context, this framework manifested through appointed agents who integrated European resources into domestic markets, infrastructure projects, and commodity trades. The resulting network influenced sectors critical to national development, including transportation and raw materials essential for industrial progress. Over time, these connections evolved through partnerships with prominent American financiers, contributing to monetary stability measures and institutional reforms. Contemporary manifestations appear in advisory services, asset management, and elite social overlaps that extend the original banking reach into diverse fields. The American entry point occurred in 1837 when August Belmont assumed responsibility for Rothschild interests amid financial disruption. Belmont formed a dedicated firm in New York that channeled funds into railroads, municipal securities, and private ventures. This arrangement positioned European capital as a supporting element in the expansion of American industry and commerce. Belmont maintained close oversight of commodity markets, particularly cotton and tobacco, which formed vital components of the national economy. The agent's activities aligned Rothschild investments with broader economic trends, creating a sustained presence in U.S. financial affairs without requiring direct family relocation or overt control. Partnerships with leading American bankers further amplified the network's effectiveness during periods of instability. Joint efforts with J.P. Morgan supplied gold reserves to the Treasury between 1873 and 1896, addressing recurrent liquidity shortages through coordinated transatlantic operations. These interventions demonstrated the capacity of interconnected financial actors to stabilize national systems when public mechanisms proved insufficient. The collaboration extended into discussions surrounding central banking structures, reflecting a shared interest in long-term monetary organization. Such alliances illustrate how historical banking networks adapted to emerging American needs while preserving their foundational emphasis on strategic capital deployment. Historical American financial integration. August Belmont's arrival in 1837 marked the formal incorporation of Rothschild capital into the United States. The New York-based firm he established managed a portfolio that included railroad securities, state and municipal bonds, and stakes in emerging industries. Belmont's role encompassed commodity speculation, with particular attention to cotton and tobacco markets that underpinned Southern agriculture and Northern manufacturing. This engagement ensured Rothschild exposure to cyclical fluctuations in American production and trade. The agent's correspondence and market reports provided detailed intelligence that informed investment decisions across the Atlantic. During the Civil War era, Belmont's firm supported Union financial requirements by facilitating bond placements and discouraging European lending to the Confederacy. The approach preserved Rothschild holdings in a unified national economy while avoiding high-risk exposure to secessionist debt instruments. Post-war Reconstruction created additional opportunities for large-scale government loans arranged through established partnerships. These transactions reinforced the network's utility in addressing fiscal recovery and infrastructure rebuilding. Belmont's sustained activity laid a foundation for subsequent Rothschild-related involvement in American capital markets. The 19th-century railroad investments represented a core element of the network's American footprint. Funds channeled through Belmont supported lines that connected agricultural regions to industrial centers, enhancing national connectivity and commodity distribution. Securities in companies such as the Louisville and Nashville and Missouri-Kansas-Texas railroads formed part of a diversified portfolio managed from New York. These holdings aligned with broader European interest in transportation infrastructure that facilitated resource extraction and market access. The pattern of investment through local representation allowed consistent participation in American growth sectors without establishing a formal family branch. Crisis intervention and institutional development. The repeated economic panics of the late 19th century prompted coordinated responses from major financial houses. Between 1873 and 1896, Rothschild interests collaborated with J.P. Morgan to deliver gold shipments totaling $62 million to the United States Treasury. These private interventions restored confidence in the currency system during periods when Federal Reserves approached critical lows. The mechanism relied on established transatlantic relationships that enabled swift mobilization of bullion and credit. Such actions underscored the interdependence of European and American financial stability. The planning process for central banking reform in 1910 involved key figures from the Morgan orbit, creating a context in which Rothschild-associated networks were indirectly implicated. The resulting Federal Reserve framework addressed long-standing concerns about monetary elasticity and crisis management. While domestic actors dominated the institutional design, the prior history of collaboration with European banking houses provided a backdrop of shared expertise in large-scale finance. The transition reflected evolving needs for structured oversight of the national banking system. These crisis interventions and institutional contributions highlight the network's role in supporting systemic resilience. Private capital inflows during panics complemented public efforts, demonstrating the practical value of interconnected financial relationships. The cumulative effect strengthened the position of European-linked agents within American economic governance, establishing precedents for future advisory and investment activities. Transitions into media, real estate, and elite associations. The 1988 acquisition of Macmillan Incorporated, encompassing scholastic publishing assets, represented an expansion into educational and informational sectors. Robert Maxwell executed the purchase with advisory support from Rothschild-related entities, securing control over textbook production and children's literature distribution. This move integrated the network into channels that shaped public knowledge and educational content. Maxwell's subsequent financial difficulties, including a reported £50 million obligation tied to central banking institutions, concluded with his death in 1991 following documented tensions. Ghislaine Maxwell and Jeffrey Epstein established a presence in New York real estate beginning in 1992, occupying properties at 9 East 71st Street and later 11 East 71st Street. These adjacent holdings formed a concentrated base for social and business operations. A trust-mediated transfer in 1998 conveyed one property to Howard Lutnick, creating neighbor proximity that persisted into subsequent years. The arrangement facilitated overlapping interactions within elite circles centered on Manhattan's Upper East Side. Epstein's activities included private island access arranged for Lutnick family members in 2012, alongside funding provided for select events in 2015 and 2017. Additional intersections involved Terramar, a marine conservation initiative co-founded with contributions from Lutnick relatives in 2013. These connections illustrate the extension of historical financial networks into contemporary social and philanthropic spheres, where personal relationships reinforced business and advisory linkages. Contemporary financial and political intersections. Cantor Fitzgerald, under Lutnick leadership, secured significant insurance recoveries following 2001 events and maintained reconstruction partnerships over subsequent decades. The firm's bond trading operations aligned with post-crisis financial flows, generating returns from government securities and related markets. Recent tariff policy adjustments in 2026 produced additional gains for the organization now directed by Lutnick family successors. Lutnick's advisory position within executive circles further embedded the network in current policy environments. Edmund de Rothschild Group maintained contractual relationships with Epstein entities during the mid-2010s, including a $25 million agreement for analytical and planning services. Meetings and communications involving senior family members occurred over several years, reflecting ongoing engagement with select financial intermediaries. These arrangements demonstrate the persistence of advisory functions within elite networks that intersect with broader investment and risk management activities. The cumulative pattern reveals a trajectory from 19th-century agent-based entry to 20th-century partnerships and 21st-century social and political proximities. Each phase adapted to prevailing economic and institutional conditions while preserving core elements of capital deployment and relationship maintenance. The network's adaptability across sectors and eras underscores its structural resilience within global finance. Conclusion. The Rothschild financial framework originated in European government lending and commodity facilitation before extending into American markets through dedicated representation. Belmont's 19th-century activities integrated capital into railroads, commodities, and crisis response, establishing a foundation for sustained influence. Partnerships with American bankers during panics and monetary reform periods reinforced this position within national economic structures. Subsequent developments incorporated media acquisitions, real estate concentrations, and elite associations that broadened the network's scope. Maxwell's publishing involvement transitioned into Epstein-related social and financial interactions, which in turn overlapped with Lutnick family enterprises and political roles. Contemporary advisory contracts and policy alignments illustrate continued relevance in high-level finance and governance. This progression reflects a consistent strategy of leveraging relationships, capital placement, and sectoral diversification. From infrastructure investments to modern advisory engagements, the network maintained operational continuity across changing contexts. The documented interconnections across time and domains affirm the enduring significance of strategic financial positioning in shaping economic and institutional landscapes.